say something more about yourself, and Jesse, feel free to do that.
Okay. Okay, great. Anita, thanks for the introduction. As Anita mentioned, Jesse and I are with an accounting firm headquartered here in Cleveland, Ohio, Meaden and Moore. We are a full-service accounting firm ranging from small business up to lightly traded, publicly traded companies, and all the accounting services that go with that, tax and accounting. We're here today to talk to you about the employee retention credits and specifically how they relate to nonprofits. I'm going to handle the first part of the presentation, speaking more so about the background of the credits, and then Jesse's going to jump in and really tailor how it applies to nonprofits. Next slide. So there's our introduction. Again, my name is Dan Prendergast, and Jesse is my colleague. He'll be helping me today. Our slides are peppered with some comics and humorous anecdotes to hopefully keep you awake and smiling and laughing through the whole thing. So next slide. So what are we talking about today? The overview is the employee retention credit. So the retention credit is a direct cash refund from the federal government, from the IRS. It's basically related to payroll taxes paid. So if you don't have payroll, you're not going to claim the credit. But it really focuses on a decline in receipts. So the tenor of the credit is comparing your operations in 2020 and 2021 to a base period of 2019. So if your business declined in 2020 as measured quarter by quarter, you may qualify. Also, the same is true for the first 3 quarters of 2021. Far and away, the most attractive opportunity is 2021 because the credit is very much expanded than from where it is in 2020, but we'll go through that. So we're looking at declining gross receipts, not just revenue. Quarter by quarter, it starts for the first quarter of 2020. Your receipt of the PPP forgiveness loan is not considered a receipt for the purposes of this test, so you can ignore that. And there are basically 2 basic ways that you can apply or qualify for the credit: a full shutdown or a partial shutdown. Jesse's going to get into more what that means. But the time period, as we mentioned, it starts March 13th, 2020 and goes to September 30th, 2021. Those are the quarters where you may find yourself eligible for the credit. There is a definitional constraint about employers. If you're a large employer, that was determined to be 100 employees or more in 2020, and it went up to 500 in 2021. This matters greatly because it meant the large employer standard was pretty limiting. And once you're a large employer, a lot of the expenses that qualify for the credit wouldn't qualify you as a large employer. So we'll skip over that. Next slide. So what are the differences between 2020 and 2021? So in 2020, you had to show a 50% decline in gross receipts compared to the same quarter of 2019. So you'd look at the gross receipts you had for maybe the second quarter of 2019 and compare them to the gross receipts for the second quarter of 2020 in 2020, and it was a 50% decline that would qualify you. In 2021, it was only a 20% decline. And I mentioned that the 2021 quarter or time periods were much more fruitful. As you can see here, under the 2020 credit bullet, for 2020, the credit or the refund was $5,000 per employee for the whole year. So the max you could get for one employee was $5,000. In 2021, that became $7,000 per quarter. So $21,000 per employee in 2021 versus $5,000 in 2020. Now, the credit was originally legislated to be applicable for the entire year of 2021. Biden cut it off at September 30th, which most people saw as admission that the credit was probably a little bit too rich, too overreaching for what they were trying to do. So anyway, so that's the differences between 2020 and 2021. Next slide. So how do you calculate the credit? So the first thing you do is it's based on wages. As I said, you can also include in wages qualified healthcare expenses, which are listed there, self-insured options, including, and also you include Section 125 deductions. So it's the first $10,000 of wages that qualify per quarter in 2021 and per quarter as well in 2020. But again, the diminished amount of 50% in 20 versus 2021. There is an interplay with the payroll forgiveness or the PPP loans. And that is that the wages that you use for the payroll protection program loans cannot be also used for the ERC. So you can't double dip. You can't use the wages for both purposes. And there's also the family leave sick credit acts that needs to be considered. You cannot use the same wages for ERC. Next slide. Okay, so that's the basic overview of how the credit works. And largely everything we talked about there was qualifying on a revenue dip sort of mentality. Jesse's going to jump into the second standard of partial suspensions, which we found to be very fruitful for nonprofits as well as some of our other clients. But it's sort of a untapped area, we'd like to say, with respect to the credit. So Jesse?
Yeah, so as Dan said, he just kind of did the overview, and I just want to, before we go into it, we kind of geared this to nonprofit specific, but you can apply this. There's no difference outside of there's slight differences in the gross receipts calcs for nonprofits, whereas you have to include any gross investment sales versus net. If it's for profit, it's net. Nonprofit, it's gross, but those are the only differences. So all these can apply to for-profit businesses too. But we've just seen, we've been doing this for about 2 years, when the legislation came out, and, after we combed through all of the gross receipts ones, which were, the clear cut and, easily defined qualifications that we're seeing a lot of where we're finding these partial suspension qualifications come in our nonprofit practice. So, but, just a caution that, you can apply to for-profit businesses too. So the gross receipts is the bright line test. It is or it isn't. You either have the 20%, or you have the 50%. When you get into partial suspensions, it gets complicated and it's a lot more gray. The one thing, or the first thing that qualifies you under the partial suspension, is whatever decline you had. It requires a tying it back to some government entity order that resulted in that decline. That is the most important part of the test. So in Ohio, most of our businesses that we're dealing with are in Ohio. So, we're seeing all of those orders that came out in March of 2020 from DeWine and the health department, those that limited the business. If you can tie your revenue decline directly to that, that's what kind of gets it rolling. Then the next qualification, which is, in the IRS definition, is that it had to have a more than nominal impact on your business. Now, 2 years into this, there's still debates on what exactly that means. The IRS put out a bulletin early on as far as defining what nominal is, but there hasn't been much clarification since then. And I'm sure some of you have seen or heard ads on the radio. There are some of these, what the AICPA has deemed ERC mills, that take a much more aggressive approach as to what a government order is. So yeah, that's just something to keep in mind. But as far as we're concerned, the government order is the most important. The nominal impact is the next. And we'll get into more of kind of some examples of what that may look like. So first, we'll go into what isn't a partial suspension, because this is defined in the bulletin and outlines. They outline a lot of what doesn't qualify. So again, if it's unrelated to a government order, if you decided as a business that you were going to keep your employees home, or you were going to close the shop, and there's nothing that said that you had to do it, then you don't qualify. You have to be able to tie it back into some government entity, whether it's your city or your county, or, that said you can't do this certain thing that restricted your business. And then the other thing is if a government order reduced demand. If it was just that your customers stayed home, but you were able to operate fully, that doesn't qualify. And again, as with all this, it's kind of a gray area of, was it a lack of demand, or was it, so that's part of what we do when we're looking into this. Every single partial suspension opportunity or case is different. So again, these are just some high level examples, and just to give you an idea. Skip over that. So common partial suspension qualifications for not-for-profits. Again, a reason why we see not-for-profits qualifying more so than for-profits is many of the orders that were put out limited interaction with the public, because it was all about, slowing the spread, and, especially early on where things were shut down. And the majority of not-for-profits are dealing directly with the public. Whereas if you're a manufacturer, it's harder to get there. If you run you run a plant or a shop, and you're not really ever face to face with customers. And if you are, it's a very limited amount. And, that becomes another thing. But with most not-for-profits, you're out in the community, and there are a lot of things that you wouldn't have been able to do, or had to either cancel or modify, that may have had, this more than nominal impact on your organization. So a lot of the ones that we're seeing are capacity limitations, which social distancing, and then available hours. We'll go into it more. We've seen a lot of nonprofits who have a thrift shop or something that they do in order to, they take donated goods and they resell them for, in order to further their mission, where that was subject to, the same restrictions as any other store, and you get to it that way. While we have it down there. And then we have something like a museum, stuff like that. Another one that we're seeing, and this is probably the one that's missed the most, but the most common in nonprofits. Most, at least that we've seen, have at least one type of special event that goes on in the year, annual gala or fundraiser that is, really a large generator of revenue for the year for the nonprofits. Many of these events, especially these larger galas and dinners, fell under the restrictions of total, there are specific restrictions on large gatherings. At a point, it was 50, you couldn't have more than 50 people, and that spanned from about March through November, and then March through November of 2020. And then starting in November, it got cut down to 10. You couldn't have anything with more than 10. So we're seeing a lot of, especially ones that would have happened this time of year, year-end events that had to be canceled, that are resulting in the qualification. So it all goes back to that 10% test. So what you do is you combine it. So if you said in the fourth quarter of 2020, we have our annual gala, and in 2019, that generated 25% of our total revenue for the year. But we had to cancel it, and we had zero or very limited, maybe it moved to online or you did something alternative. But because in 2019, that event generated more than 10% of your revenue, and it's in that quarter is what the test is, then you would qualify in 2020. And then if you qualify in 2020, it applies to the payroll for the whole quarter. So, what we're seeing is, and in that case, with how 2020 is, and as Dan highlighted, that it's the max is 5,000 per employee, there's a very good chance that, you may only get that one quarter, but you're able to maximize ERC. And then in that instance too, if your PPP loan was from early May to end of October, then you don't have any of that overlap. So that's something that we're seeing pretty common. So as we said, some specific examples. We've seen a few of these, large organizations that have a thrift store that furthers the mission. Stores were shut down, and it gets that qualification. Another that we've seen a lot of are community health clinics. Again, you're working with the public. Even though they were deemed essential and never shut down, a lot of them had to modify the services that they could provide, whether that's limiting hours, whether that's going to telehealth, or it could be that we're seeing that there's just additional time per patient, due to these orders. And that we're seeing in a for-profit context, and dentists, doctors, and if if you've been to the dentist or the doctor, in the last couple of years, even though they've, things have changed a bit, but, waiting rooms were shut down, there were pre-screenings, all of that added time to the appointments. So again, if you're dealing with a nonprofit with already limited resources, dealing with the community, and you had to add all this time, the total population that you could service was decreased by the government orders and the time per patient or time per visit. So that would get you there. And then we covered the fundraising example, which is, again, one of the most common that we're seeing. So then, and this can, we can kind of cover on the employee retention credit in general, is, as Dan mentioned, it's a payroll credit. So you're dealing with, it's a credit on your FICA taxes. So you file your quarterly 941s, and in order to claim the credit, you file a 941X, which is the amended Form 941. And with that, it's the same rules that apply to regular tax returns. So you have 3 years from the date the return was filed to amend it. So for Q2, and again, even though the qualification starts in Q1 of 2020, the filing on the form starts in Q2. So for Q2, you have until July of 2023, and then every 3 months, ish, they will start expiring all the way through October of 2024 with Q3 of 21. So for each, you have to fill out this 941X with the changes that are reporting the qualified wages and health expenses. But then as far as the partial suspension goes, there's additional documentation as your conclusion on how you got to that more than nominal effect. So what we do is we gather the data, you determine that it had the effect, basically put it into memo form of, these are the specific government orders, this is what our revenue was in the quarter or the period in 2019, this is what it was in 20 or 21, and this is the impact that it had on the organization. And that is kind of getting your ducks in a row as far as if it were ever to be audited down the line, that you have everything, for the basis of your conclusion. Because as we said, or as I said, there's not a whole lot of guidance on this. And there are people out there, organizations out there that are taking extremely aggressive approaches. Not something that we do. And that's why, as part of this, we kind of lay it all out there that as far as our understanding of, what the credit is for, what the requirements are for, XYZ, these are the orders, and this is why we did it. So that is one of the most important parts of it. And we find that for a lot of organizations, you hear this if they've heard of ERC, and they say, well, we didn't have the gross receipts decline, because we do see that, early on in the pandemic, a lot of nonprofits had increases in gross receipts, whether it was from the stimulus or people just, giving back more. We do see a lot where donations went up, but that doesn't necessarily mean that you don't qualify based on these other, these other qualifications. But a lot, they just look at, year over year, I'm not down 50%, so there's no way I qualify. But it's a lot more nuanced than that. And I'd say over half the time we start a conversation and organizations think they probably don't qualify, and you ask a few questions and it's like, oh yeah, well, we forgot that we had to cancel that, or we forgot about this. And, so there's a lot of opportunity there. So that's pretty much, that covers everything. And, I'd say going along with, the mission of SCORE is that we're seeing that, again, a lot of these ERC firms that have come out are really focusing on trying to get as much of a credit as possible, because they by and large, they all charge a contingent fee. It's somewhere between 15 to 25% of your total credit. And they want to be as aggressive as possible and, they just throw out, numbers at you and, hope that you sign, and they're just kind of playing the game that they can't all be audited. But we're seeing that, a lot of these smaller nonprofits are ones where, there is opportunity there, and they're really the ones that qualify. And sometimes it's on gross receipts too, and they're just not getting or don't have the, sophisticated accounting teams or relationships that are really identifying this. Because even in, even what we're seeing, you have ERC firms, which, some I'm sure are reputable, but a lot of them seem a little shady. And there's a very small percentage of public accounting firms that have really dipped their toe into this. So there's a lot out there, organizations that could use this money that, haven't gotten the opportunity. And then
it's like some point, Jesse, I just want to add, it's unfortunate the way the credit has worked mechanically, because the credit was really designed to basically save a failing business. And we see lots and lots of our clients take advantage of these credits, and it helps them. But when the credits first started, it took well over a year to get the refunds. So, if your business really was in trouble, the chances of you still being around by the time the credit showed up probably weren't great. That's gotten a little better. We're down to 5 months in a lot of cases. The bigger your credit, we find, though, the longer the time it is to be received. So, Jesse did a nice job of painting a picture of there's some providers out there that maybe aren't the most ethical. The big question mark is, the IRS was just recently awarded a significant appropriation of $86 billion. And, there's been lots of press that they're going to start going after some of this stuff. So we hope that there'll be a real kind of writing to the scales there, and the providers that were basically producing credits that weren't just will have their day in court, so to speak. So if you do find that you're approached by one of these people, the key is, as Jesse mentioned, if they're going to mention that they get a percentage of what they find, that's almost an automatic red light that they're not probably doing calculating the credits in your best interest. They're just doing them for their best interest, for their fee structure. And I know, Jesse, you've seen some that were really egregious, that look at minimal things in disruption to your business. Things like, the state of Ohio said we all had to wear masks, and try to claim that that's a reason for the slowdown in the business. That's not a significant reason. You can do your job with a mask on just as well without, and those sorts of things. But there are people out there taking that stance, which is incredibly aggressive and abusive, to be honest. So we'll see where it all ends. But for now, it's we're at the forefront of the audit period. You haven't seen anyone get audited yet, have you, Jesse? I have not.
No, and it seems like, so, I do a lot of this within the firm, and the IRS has already identified, they expected the entire program to cost somewhere in the range of $2 trillion, for all of the credit. They've already identified over $2 trillion worth of fraud. So, it's significant. I mean, they're definitely, that's part of what's caused slowdowns in getting the credits, is that they're amping up the enforcement before they authorize. They're kind of pre-auditing some, because a lot of what they're seeing is companies that are claiming credits for employees they don't have. It's not so much, it's difficult for them to determine, whether you qualify or not based on their definitions, but a lot are just coming in and saying, well, we're just throwing this number out there. So I think of the fraudulent ones they found, it's like, it was something crazy, like an average of like 20 million per claim, which based on the limitations, it's unlikely that, that's even possible to have that much. So, but, and that's the caution of it, but it doesn't mean, not to look at it. And that's where I'm kind of saying we're, it's like the aggressive ones and the ones doing that have kind of ruined it for the rest of them that really do qualify, because people are a little hesitant to step in. And a lot of these organizations that really are, I mean, the spirit of the law was written for, smaller businesses and smaller organizations that needed help through this period. not the, you know, conglomerates that just want. you
Well,
know,
we certainly have small businesses. We generally don't mentor very large nonprofits. So I allowed everybody to open their mic if they want to ask a question. And I see Bob Fedor. Would you like to say something?
Yes, well, it's a question. Thank you, Anita. I'm familiar with a few churches that have taken PPP loans. Have you seen the churches being eligible for this credit?
They are, and we've done, lately, I've done a lot of churches. So the only caveat with churches is, which sometimes helps with the PPP loan, is that majority of clergy do not pay, or not required to pay FICA taxes. So they aren't eligible, but if there's any other, you know, people that work there, they do. And that's one of the, you know, a lot of them qualify on some aspect of the partial suspension, you know, due to limitations, even though churches had specific carve outs, but still we're finding that, you know, they weren't able to do everything they could do before. But yes, as long as, if you got PPP, so that's part of what we do too, is, so the only, I mean, there's other rules, but one of the major rules, or one of the major things that you have to look at, is that you took a PPP loan, whatever you used for wages for that PPP forgiveness can't be used again for ERC. So you can't double dip. So whenever there's a PPP loan and we do one of these, we basically go backwards. We say, okay, we need to have enough wages and expenses for full PPP forgiveness based on what you filed. And then anything left over is eligible for ERC. And I'd say 95% of the time, there's no issues as far as being able to maximize both. Sometimes you run into it, but still, even in the case, there's still some left over for ERC.
Well, for a church with significant staff, that could be a lot of money.
Yep. Yeah, and that's, I mean, and so then with nonprofits, when you're dealing with for-profit businesses, you have to take into account, you know, depending on what the structure is, you may have to do corporate and individual amended returns, because you have to report it back. Whereas with nonprofits, it's, and, you know, we've taken the position with our nonprofit team, and others have, that, you know, it's an information return. So as long as you report it, you know, in whatever, 22, 23, you don't have to go through that process, and you're not paying tax on it. So that is the main difference between PPP and ERC, is that ERC is taxable by way of an expense disallowance for the wages. But that doesn't apply for nonprofits. So that's really where I mean, we're seeing the biggest impact on a lot of these smaller nonprofits that have a good size force when you get into the qualification in 2021 of potentially 7,000 per employee per quarter. We're seeing some pretty large refunds.
So, would you second question, do you feel that most, we'll call them medium-sized nonprofits that could be eligible, are aware of this in Northeastern Ohio?
No, I don't think. Even we've gotten some referrals from other public accounting firms that have not, and larger size of firms that just haven't touched it. And again, this isn't what we do. We just have a small team that's kind of jumped in early on, and I think got ahead of the curve. But I feel like a lot of these aggressive firms they came in early when people hadn't had a chance to look at it. And now they've gotten such a poor reputation that a lot are just happy to not, get involved in it. But no, we've gotten, I'd say, a dozen or so nonprofits from other, like competitor firms that we've talked to and ended up qualifying. And they've said they haven't even heard it from their firms.
So
Would-
would you recommend that we suggest to our nonprofits, if they haven't looked into it, that they inquire, especially if they haven't gotten PPP loans, that they might be eligible?
Right. Yeah, and if you don't, I mean, if they haven't gotten PPP loans, but they have wages, it becomes even easier because you're not worried about the overlap. But yeah, I would recommend, I mean, I'd say it's hard to put a percentage on it, but more often than not, nonprofits will qualify at some, whether it's for one quarter or, we've had, it spans. I mean, we've had some, I was working on one today where it was a organization that had a thrift store and we're just focusing on the one quarter. But I've had others that it's, Q2 2020 through Q3 2021. And in a lot of cases where, the cost of wages is a large portion of, the total, or if all the expenses that, when you're looking at 70% of payroll costs for 3 quarters in 2021, it's,
Right.
it's significant.
Well, if they have gotten PPP loans, why would these be different? Why would what they're getting for PPP loans won't already have covered this same?
Because a lot of the, it has to do with how the PPP loan was calculated. And so most of them were 2.5 months of average wages. So that covered a period. The employee retention credit was basically passed as it's a supplemental. It's
Okay.
for companies who, it was just an added, on top of PPP. So it's in addition. So you just can't.
Okay, so it's a different time period.
It spans the same time period, but it's
Well,
yes, PPP's fixed into those 8 to
Yeah.
24 week windows, whereas ERC is just all quarters from Q2 2020 through Q3 2021.
okay, so even if they have gotten a PPP loan, they should inquire to see if they might be eligible for the ERC.
Yep, and in a lot of cases, if they got, and that's kind of like a litmus test we've done, if they got a PPP2 loan, especially as a nonprofit, I'd be very surprised if they don't qualify for ERC. Because if they got the PPP2, then that means they had that 25% decline.
No.
So the key issue is you have to have 10% reduction in receipts.
Receipts is the easiest, and but it can be hours, it can be services, but as a high level test, yeah, 10% of gross receipts.
Coupled with a mandate or shutdown.
Right. So that's why, when we talk about with nonprofits in Ohio, like I'm very familiar with the Ohio orders. That's why I guess I confidently say that if they have the drop, they'll probably qualify. It's obviously not every case is different, but the majority of the restrictions that were put in place were on, interfacing with the public. So that's right. You're right in the nonprofit niche.
Okay, are there any other questions? Anybody who would like to unmute themselves and ask a question, feel free to do that. Well, apparently not. So I guess you've been very clear. And I certainly appreciate your giving us this information. I think it's very helpful. As I said, I do a lot of nonprofits, and I'll be sure to mention this to those of my clients that might be eligible. I think that's really an important thing.
Yeah, and our info will be out there. If you put them in touch with, I'm always happy to answer a call. And again, I've been doing this for the better part of a year and a half or so, and I think doing it for nonprofits is it's been the most rewarding for me because a lot of times they need the money, it'll go to a good cause and it, you know, it's out there and they're eligible for it. So I'm always happy to help, you know, walk people through that.
Great. Okay, well, thank you both, Jesse and Dan, for spending this time with us. And also for those of you who came, I hope you found the information helpful. And